We're going to start the panel. Brady will introduce the panel. Our first speaker then has to go right to the airport. So I'll say a word about him, Brady. Is that all right? Because we're neighbors in Sarasota. And Dennis Archer, among a distinguished career as a Supreme Court Justice, the first African-American president of the American Bar Association, and a terrific mayor of Detroit, has agreed to join this panel on municipal finance, tax-free bonds, state and local government, pensions. Now, you saw some references to it that Bob Grady put up. We're going to talk about it. He flew in last night. There's a car waiting to take him to the airport to fly out. And I personally need to thank a personal friend for making the trip. That's the unofficial introduction, Dennis. We have one question for you if you would take your iPads, just one. This is a session on municipal bonds. If I can get the slide to move. Leanne? All right. I have it on the pad. Here it is. Okay, everybody ready? Just one question. Holding of tax-free municipal bonds directly or through a mutual fund? A simple question. A, I own municipal bonds. B, I do not own municipal bonds, in which case go take an hour coffee break. C, I don't know if I own municipal bonds, and that may be possible. Ready, get set, go. Well, the 14% I want to talk to you later. Okay, I own municipal bonds. I don't own municipal bonds. About a 50-50 split. An hour from now, you may all want to have different opinions. Brady, your panel, please.
Very good. Appreciate that, David. It's great to be with you today. This is an incredible panel that we're going to have a discussion on the municipal bonds, failures, or successes and failures. Something that we've found, especially as of late with the recent news out of Puerto Rico and some of the other municipalities, this has very quickly become our hottest panel, just simply because of the recent news in the last week or so. As David had said, we have, actually let me introduce our panelists first. Our first panelist will be Dennis Archer. Dennis is the former mayor, City of Detroit, Chairman and CEO of Dennis W. Archer, PLLC, and Chairman Emeritus of Dickinson Wright, PLLC. After Dennis, we will have John Mousseau, who is Executive Vice President and Director of Fixed Income with Cumberland Advisors. Natalie Cohen will follow John. She is the Managing Director and Head of Municipal Research at Wells Fargo. And Mary Francoeur will be our final panelist speaker. She is the Managing Director of Assured Guarantee. So in the spirit of time, let's go ahead and turn that time over to Dennis.
I own municipal bonds. David, thank you very much for your courtesy in allowing me to be able to make my plane. I appreciate it. In November of 1992, after resigning as a justice of the Michigan Supreme Court, I declared my candidacy to become mayor of the city of Detroit because I wanted to make a positive difference in the city of my birth because I wanted to improve the quality of life for our residents and citizens within our region, and because I wanted to improve the image of the city of Detroit. I was elected mayor of the city of Detroit in November of 1993, and I began my work in January of 1994. I also inherited an $88.5 million deficit with 6 months left on Mayor Young's budget year. I served 2 four-year terms as mayor and decided not to seek re-election for a third term, ending my services on December 31st, 2001. During those 8 years, our administration had not only a balanced budget, but also a modest surplus and a rainy day fund each year. And during my tenure, our pension fund was at one point overfunded by $921 million. According to Site Selection magazine, our administration led the nation in attracting new businesses. 3 of those 8 years, we attracted over $20 billion in new investments and created thousands of new jobs. We won and had the most successful empowerment zone in the United States. We reduced crime, and Detroit was considered a comeback city as a result of the positive stories written about our city in the national press. Our property values increased. Despite all of those gains, Detroit lost 7.5% of its population decade over decade, a population loss that began in 1953, following our high point in 1952 of 1.82 million people. During the annual meeting of the U.S. Conference of Mayors in Dallas last month, everyone was given a report from the Economist magazine's Economist Intelligence Unit entitled, quote, Hotspots 2025, Benchmarking the Future Competitiveness of Cities. In its executive summary, they declared the following: 100 years ago, only 2 out of 10 of the world's populations were living in urban areas. By the middle of the 21st century, 7 out of 10 people will be living in cities. Already, global business is beginning to plan strategy from a city rather than a country perspective. Understandably so. Well over half of the world's population lives in cities, generating more than 80% of the global GDP. Standard population projections show that virtually all global growth over the next 30 years will be in urban areas. The number of people living in the world's cities is growing by nearly 60 million every year. North American and European cities are among the world's most competitive today and are likely to retain their advantage until 2025, despite concerns over aging populations and infrastructure, indebtedness, and slow growth. The report outlines what makes a city competitive in light of these changes. Competitiveness is a holistic concept. While economic size and growth matter, several other factors determine a city's competitiveness, including its business and regulatory environment, its institutions, the quality of human capital, cultural aspects, and the quality of environmental governance. These factors not only help a city to sustain high economic growth, but also secure its future competitiveness. The report listed 120 cities in their overall 2025 City Competitiveness Ranking Table. There were, as I recall, 14 American cities within their 120. They noted the top 5 American cities within the 120, and here's what they said. New York is the most competitive city today and will remain so in 2025. The city makes its gains in almost every major category. It tops the rankings in terms of financial maturity, and it's among the most competitive on institutional character, second, and economic strength, third. While building on its strength as the world's financial capital and a magnet of opportunity for people from America and beyond, The city owes its competitive edge in 2025 to improvements in other areas. Now, just as an aside, I pause to remind all of us that New York was on the verge of bankruptcy in the 1970s, but was bailed out by a federal loan of $2.4 billion thanks to President Gerald Ford and a thoughtful Congress. The report continued. Chicago ranks ninth in the overall index as is America's second most competitive city after New York. As America's second most important financial hub after the Big Apple, Chicago ranks 20th in the category of financial maturity. It ranks above any other U.S. city on its environmental governance and ability of dealing with environmental challenges, a joint fourth position. Its public transport plan runs until 2040, and its water management plan controls water quality, supply, and demand through 2050. Washington, D.C. is America's third most competitive city and ranks 14th in the overall index. America's capital is a good all-around performer. It scores particularly well in the categories institutional character, joint fourth, social and cultural character, a joint sixth, and financial maturity, a joint 32nd. The city is seen as one of the worst U.S. cities in terms of traffic congestion and waiting times and investment in physical capital, a joint 31st, and is currently not a priority. There has been dramatic improvement in the telecommunications infrastructure with a rise in broadband adoption and Wi-Fi spots, making Washington a wired city to watch. Los Angeles ranks 17th in the overall index, ascending by 7 places between 2012 and 2025. The city is the second most competitive U.S. city in terms of economic strength, ranked 27th globally. It is one of the largest and most diverse jurisdictions in the United States and ranks third in North America on global appeal, 21st overall. The city scores particularly well in the category of social and cultural character, a joint sixth, a reflection of its cultural diversity, openness, and tolerance. San Francisco is ranked 18th in the overall index and the fifth most competitive city in the United States. It is the second best performer on North America's West Coast, behind Los Angeles, which is 17th, but ahead of Vancouver, which is 28th, and Seattle, 35th. The city performs particularly well in the category of institutional category, a joint second. As a specialized global hub for IT venture capital and private equity, it ranks joint 32nd in terms of its financial maturity. Citi also provided a handout, City for Cities, which read in part, today more than half of the world's population lives in cities. The United Nations predicts that the world's population is expected to grow to 9.6 billion by 2050, with nearly 7 billion people living in cities. This growth poses unprecedented challenges in the area spanning from health and education to infrastructure, transportation and trade, but also exciting opportunities to innovate new solutions. As a global population undergoes transformational shift to urban areas, decision makers across sectors must take steps to help ensure their cities are equipped to manage and support this growth. Citi, it says, is committed to enabling urban progress and strengthening communities worldwide. Through Citi for Cities, we are partnering with governments, businesses, citizens, and community groups to identify and implement innovative solutions that spur job creation, drive efficiencies, and enhance quality of life, ultimately supporting the growth of cities worldwide. We apply best practices from across the globe to address the city's unique local priorities. targeting 9 district urban ecosystems, roads and transit, public safety, city administration, social services, education, ports of entry, regeneration and development, healthcare, and energy and utilities. Backed by cities' extensive capabilities and global network, we work to modernize city infrastructure, support urban economic development and job creation, and enhance livability in cities everywhere. Given the anticipated population growth in our cities and the need to address the stress on our infrastructure, water and sewage systems, replacement of police and fire equipment, and public lighting, it should be no surprise that organizations such as the National League of Cities, the United States Conference of Mayors, the National Association of Counties, and the National Governors Associations are lobbying to preserve the federal tax exemption on municipal bond interests. No one runs to become mayor of a city with the intention of reducing city services, laying off city workers such as office staff or bus drivers or those who pick up the garbage, or in some instances, police and firefighters. No one runs to create a deficit or having their city's image turn negative. When confronted with fiscal problems, choices must be made. It helps to have an outstanding group of appointees and advisors. Chief among those needed are a brilliant budget director and a brilliant finance director. I fortunately had both. The June 2014 issue of Governing Magazine had the most sage advice I've read to help mayors, county executives, governors to avoid fiscal problems. In an article called, quote, "The 7 Deadly Sins of Public Finance," close quote, Liz Farmer began with the following warning. The temptation of the quick fiscal fix has seduced just about every lawmaker at one time or another. Scraping pennies together to balance the budget, perhaps skipping a contribution to the public employee pension plan is the best way to get through the year. Can't afford to pay for building maintenance? Push some of it off to the following year's liabilities. Governments have been using these and other money shuffling tricks since balanced budgets and municipal financing were invented. But in the aftermath of the Great Recession, short-sighted gimmicks like these became more common as governments looked for any solution to combat dwindling revenues. Ms. Farmer laid out the 7 deadly sins. 1, balancing the budget with one-time fixes. States and many cities have a legal obligation to balance their budgets each year, but there are all sorts of tricky maneuvers that can place a government's in technical compliance with that rule. Shifting payments into the next fiscal year, for example, can instantly take the problem off the current books. But it serves only to make the following year's budgeting that much more difficult. Borrowing money for operating costs and is another common tactic, may even be more dangerous. 2, ignoring the long-term consequences of a deal. Few governments have a long-term fiscal plan, and even fewer have multi-year budgets. Many don't even require a fiscal analysis of proposed legislation. That's made it possible for some facing immediate demands for wage increases to buy off public employee constituencies by increasing retirement benefits at an unsustainable long-term cost. Other governments have been wooed by the prospect of privatizing assets as a way to get quick cash, a move that some have called the government version of an unwise payday loan. 3, taking on too much. One of the reasons privatizing assets has become alluring to governments is because many of them have been burned by taking on more public investments than they could handle. This frequently involves development projects funded by municipal bonds. If a project's tax revenue don't deliver, governments have to pay the difference to bondholders out of their general fund budgets, a promise that becomes an embarrassing burden for some that can ill afford the actual risk. 4, misapplying a temporary windfall. This is a sin that many governments commit when it seems like the good times will never end. Every economic boom is followed by a bust. But elected officials are often tempted to spend the money as if it weren't true, using one-time surpluses, especially good years to cover reoccurring expenses that they will have to meet in bad years. When the downturn comes, the money to meet these expenses isn't there. Shortchanging pension obligations, number 5. The most serious threat to some government pension plans has been a chronic unwillingness by lawmakers to contribute what is necessary to keep the plans fully funded. To be sure, many governments skipped or pared down payments into pension plans during the recession. But some places did that for years prior to the downturn and continue to do it today. The longer they delay, the longer the long-term liability becomes. 6, making unrealistic projections about the rate of return. Every budget or financial planning document has to start with some assumptions about the rate of interest that will be earned on an invested portfolio. It is tempting, too tempting sometimes, to stretch these assumptions beyond what sensible economics can justify. Some pension funds still base their total liabilities owed on an expected annual investment return of more than 8%, a figure that affects the formula used in figuring out how much governments should contribute each year. A budget that expects too much from a volatile revenue stream like sales tax can be burned in any given year if the economy hits the skids. And 7 and last, ignoring financial checks and balances. Don't lose track of the money you have. It seems like the most obvious advice in the world. But in government, finance, and fund accounting, where there are many different ways to count the same revenue, weak financial controls can lead to serious dollar losses. Governments can lose track of how much money they actually owe one of their special funds, or lax internal monitoring can result in poor financial choices not getting flagged until it's far too late. My successor as mayor of Detroit committed 6 of the 7 deadly sins, and likely many others as well, but that's a different matter. He broke the law by committed perjury and engaged in criminal activity that resulted in him receiving a 28-year federal prison term. He damaged the city's image, increased the crime rate, left a $315 million deficit for his successor, and presided over a 25% population loss decade over decade. Detroit is now in Chapter 9 bankruptcy after an emergency financial manager had to be appointed to address the city's fiscal straits. Today, I am very optimistic about the future of the city of Detroit. I'm delighted that Michigan's Governor Rick Snyder chose Kevin Orr as the emergency financial manager for the city of Detroit. I believe he has been at his professional best in working to achieve an outcome that will give Detroit a fresh start. Judge Stephen Rhodes has a national reputation for being fair to everyone. Judge Gerald Rosen, the Chief Judge for the Eastern District of Michigan and the mediator for the bankruptcy issues, has been outstanding in his effort to facilitate appropriate settlements and creative in seeking solutions to the vexing issues facing the city, its creditors, and its workers. Most everyone but me was surprised that all of the unions and the two pension boards, general and police and fire, are supporting the bankruptcy plan. The largest union just came to terms on a new 5-year employment agreement with the city. I don't know how everything will be decided, but I can predict with a reasonable degree of certainty that when all is said and done, that Detroit will have a fresh start, that it will be a city that can timely pay its bills, and whether on its own or through the state, its municipal bonds will prove worthy of bond buyers. Thank you very much.
It is indeed a pleasure to be here. And following Mayor Archer, it was going to be tough. I'm going to try to keep things to about 15 minutes so that we do have some time for questions later on, because I'm sure with my esteemed panelists there'll be a few questions here. I think one of the things that Mayor Archer brought up that was very important is the fact that there are successes and failures, and really the fact that things in the world of municipal finance are anything but static. And I don't have these on a slide package today, but we did this in a presentation at the end of last year. If you went back 55 years ago, 1960, and you looked and compared the cities of Detroit and Boston, you saw a city in Boston that had about an average median family income of about $6,000 and a population of about 690,000. And you had Detroit, which had a population of almost 1.8 million and had median family income of $30,000 in 1960, mainly because so many people in the auto industry lived in the city. Jump ahead to 2010, and the Boston median family income had gone up to 61,000. The population had declined, as a lot of cities have declined, although it's coming back, as Mayor Archer talked about. That population was down to about 620,000. Detroit's population had gone all the way down to about 750,000 by 2010. And the median family income in 50 years was the same, unadjusted for inflation. So things don't stay the same, and that's certainly over long periods of time. But as we're going to see, even during short periods of time, things can change fast. One of my things that I've always thought of in the municipal bond world is that you deal with fairly low volatility on things until things happen, and then they tend to move up almost in a step function form. This is a bunch of municipal bond yield curves going back just over the last year. In fact, one of the reasons I wasn't able to be here last year as an attendee is because the bond market was in such turmoil that I really needed to be on the desk at Cumberland. But if you look back at the beginning of 2013, this is the municipal market data, which is a AAA municipal yield curve. You can see that long municipal bond yields of the highest quality were below 3%. Other bonds obviously yielding more than that. As you got out to later in the year, into April, it had changed a little bit, maybe a little bit higher yields in parts of the curve, but essentially the same. When you started to hear in May or April of 2010 about the Fed starting to taper, what you saw was the beginning, and you'll see a chart later on this, was an absolute migration out of bonds in general and out of municipal bonds in particular through bond fund sales. It was really, when you look back, it was really an overreaction to when Chairman Bernanke came out and just said, hey, yes, we would consider tapering sooner rather than later, to a question. Well, that was the match that lit the fuse that sent the bond market on its way. So by June, the market had moved all the way up to here, and then you can tell by the end of the summer, it had moved up significantly higher. So that when you looked at it, in the course of 3 months, even though inflation had come down, and even though real GDP had come down, tax-free bond yields in the long end were up almost 150 to 175 basis points. That causes huge losses in bonds, as we saw. At Cumberland, we use this as extended portfolios and durations, but the point is that to see that kind of price movement and yield movement in such a short period of time is almost unheard of, and you actually saw bond yields increasing on an increasing basis, which is also pretty unheard of. Well, since then, what happened? We got towards the end of the year. People finally realized they've been paying higher taxes during the course of the past year. I think they recognized that on a lag basis. They saw that municipal credit, which had nothing to do with this rise in yields, was actually getting better, not worse. In fact, they've gone through 16, now closing in on 18 quarters of rising municipal tax receipts. So the credit story got better. Bond inflows started to pick up a little bit. And I think people realized that, hey, the stock market just had a 35% year. Maybe it's time to put a little bit more in bonds. So 3/4 of this market, of this rise in yields, has actually been taken away in essentially about 8 months. So, I mean, it has been a remarkable rise, trip back down. This is really just comparing the same thing you just saw, the significant rise in yields last summer between not only the 30-year bond, but the 10-year bond. Interestingly enough, it was intermediate and longer-term bond yields which suffered the most rise. And of course, that's because bond funds, which bore the brunt of the sell-off, own intermediate and longer-term bonds. Short-term bond yields, hardly went up at all, which is how you could tell it wasn't a credit issue. A little bit about volatility. So we're going to get in and talk about Puerto Rico because they are demanding right now the most in terms of headlines. And the volatility of prices has been significant. This is just this year alone. And this is on a deal which the Commonwealth brought in March, $3.5 billion. It was 10 times oversubscribed. And they brought an 8% bond at an 8.75 yield to get liquidity. Since then, a lot has happened. 3 weeks ago, the governor suggested that they are going to possibly restructure some of their agencies, the Electric Authority, the Highway Authority. And right here, the first jump was to have a rise in the price of the general obligation bond. The market was thinking, well, if they're going to restructure a couple of the agencies, that probably means they're bringing a ring fence a little bit about the Commonwealth's credit itself. Well, within a few days, Moody's downgraded Puerto Rico and the agencies again, and essentially, if you read between the lines, said, hey, it's really hard to trust these guys when they've been saying for the last 4 years they're going to do everything they can with the agencies, and now they're suggesting a possible restructuring. So immediately, the GO bond took a big hit down in price. So even people that got what seemed like a great yield in the beginning, 93, have already taken off about 9 points off of their original purchase. So this kind of volatility you don't generally see in the municipal bond market. But it has not only been here, it's been on some Detroit bonds, as we'll see in a minute. More importantly is if you looked at the timeline on Puerto Rico. Puerto Rico's problems have been known for years. But it's the headline risk which really ignites volatility. And if you went back last year, here you are, January 2013, long, uninsured, tax-free Puerto Rico bonds were trading around 5%, cheaper than the rest of the market. But a lot of money rolls over at the beginning of the year. You saw a lot of people coming in buying Puerto Rico debt. Kind of continued that way until you got to August, when Barron's points out the fact that many municipal bond funds, state funds, own between 20 and 30% in Puerto Rico paper. Well, that was another match, and the Puerto Rico market has not been the same since. Here you can see some selected volatility, not only uninsured bonds, but even insured bonds. We have Mary Francoeur here talk about assured guarantee. We think assured and and National Re, which is the old MBIA, are actually very solid insurers. That does not stop from the volatility of prices because of the headline risk. You know, is there a little bit of throwing out the baby with the bathwater? You bet. Are insured Puerto Rico bonds cheap? We think so. But the distinction is huge, and the price volatility is rampant. Here is the volatility on the electric authority. Incredible. This is just volatility measurements. But look what happened as soon as the restructuring legislation was passed. Off the charts. And you know, it has continued to this day. So as we'll see, Puerto Rico paper, when you talk about selected names, are trading down very cheap. In fact, the electric authority itself is now trading down 35 to 40 cents on the dollar. And other names have held up a little bit, but they're still down a lot. If you go back 100 years, you don't see this type of volatility. But it tells you that when things happen, it's fast. It means that things are not static. It means that people need to pay attention to credits in their portfolio. That's on a fund basis as well as people that have individual accounts. Here's some selected Detroit names. The reason that we see this big swath in the middle is that a lot of Detroit names didn't trade while all of the bankruptcy was going on. The market just ground to a halt. But what was interesting, and what Mayor Archer didn't touch on, was that the day that the Detroit bankruptcy was validated in the fall, and when the bankruptcy judge said, hey, I'm going to allow the bankruptcy to go forward, he said Detroit didn't necessarily do all the things they needed to do in good faith, but on a cash basis, they probably are broke, so I'm going to let them go. And what he said, though, was, I'm not telling you that the pension funds are going to take a hit in here. But he also said, I'm not telling you that they're not. And interesting with that was the next day, Illinois, who had tried 6 other times to pass some form of pension reform and never had it happen, passed pension reform. Because suddenly, I think people said, well, I think we'd rather be part of an agreement than have an agreement dictated us to down the road. So I think there is solutions to a lot of the headline problems that you read about pensions and OPEB costs going on, but it's going to take cooperation. It can't be, we don't want to be part of this. There's some more Detroit names. Again, trading more or less suspended during litigation where you didn't see any trading. But what's interesting is that, and this is a good point in municipal finance in general, one of the things that Kevin Orr is trying to do, is to take the Detroit Water Authority, in which bondholders have a senior lien on the water revenues, and he wanted Detroit to start to get paid first out of those, and to restructure the agency, and essentially provide more cash into the city of Detroit. Now, this will be ongoing litigation, but even after all that, uninsured Detroit water bonds are trading through a 6, about a 580, and the insured bonds are trading around a 5. So there, the legal security of having a lien on the water and being paid first is really showing up in the bond market, because these yields are significantly less than the Puerto Rico yields. Look at the volatility. This goes back again to what I talked about last year. You're moving along, very little volatility. Here is this tremendous time period in June and July where you couldn't get a bid on bonds. Had nothing to do with credit. It had everything to do with liquidity. And the fact is that you sat there and you saw day after day, week after week, of bond funds just throwing paper out because they have to pay for redemptions. It was probably the single cheapest time to buy municipal bonds relative to inflation since I've been managing money, and that's 30 years. A little bit here. Municipal bonds, in our eyes, are still cheap, even with and the problems that you're reading about out there in different cities. is that that's probably keeping headline risk high. It's probably keeping yields high. This chart compares a long maturity municipal bond index, the bond buyer 40, to a 30-year U.S. Treasury yield. If you took this chart back 100 years in the left-hand side, it would almost always look red, with the municipal bond yields being less than Treasury yields. Why? Because you pay taxes on Treasuries and you don't pay them on tax-free bonds. It has been upside down since the financial crisis. This is the period of time following the Lehman failure. What'd you have? You had 30-year Treasuries at 3, and you had long tax-free bond yields at 6. Does that make sense? No. In fact, that's one of the reasons why you actually started to see the Fed do their first rounds of quantitative easing. Not so much to bring down Treasury yields, they were already low, but to bring down yields on everything else. Because not only were munis screwed up, but corporates were too, mortgages were too. And to that extent, the Fed has been successful. But it hasn't kept munis from being still cheap, cheap, cheap in our view. And it means that we continue to devote some part of portfolios to the longer end of the municipal bond market. And in our eyes, when the Fed finally is done tapering and finally gets removed from the day-to-day really inclusion in the markets, which has not been their hallmark prior to the financial crisis, we think that this ratio of munis to treasuries goes back, to something normal. A long muni bond yielding you 90% of a treasury bond, something along those range. Which means that we've been including tax-free municipal bonds even in some selected taxable portfolios like pension funds and charitables and trusts and things like that. Because we know that that provides an amazing amount of defensiveness, being as cheap as they are. A little bit about bond fund flows. Here's the culprit from last year. You're moving along positive all during, these time periods. This is the Meredith Whitney meltdown when she said all was going to go heck in the municipal bond market and there's going to be hundreds of billions of municipal defaults. Didn't happen. Great positive, flows. And here you go. People would say to us, hey, did you guys see this coming with the bond funds? Well, how could you? You had slightly negative, positive, a little bit negative, positive, and then the bottom falls out. But here you go. You finally have started a resumption of some positive flows. So in our eyes, we think the volatility continues on the credit side. We think the vigilance is needed on the credit side. We think that the market has turned around, just from what we saw with a sharp drop in yields this year, and that people are recognizing that last year was way overdone. Thanks.
Okay, I'm Natalie Cohen. I'm talking fast in the interest of time. I was hired 4 years ago by the Wells Fargo Research Group, mainly the equity group, to start writing about municipal government, tax-exempt bonds, and all kinds of other topics. I now have a team I just want to mention. We're a small team of 4. I have a specialist in healthcare. He's literally a walking encyclopedia, so if any of you are interested in healthcare reform, its effects on the states, how they're handling it, the Medicaid expansion that was discussed earlier, he's a great resource. And an infrastructure specialist who covers airports, ports, utilities, toll roads, all the different infrastructure investments. And we also cover higher education, and we are watching some of the phenomenon in the funding of higher ed and some of the shifts. We've written about that. And I pick up a lot of the other topics, whether it's strategy, public pensions, I'm going to talk about that in a few minutes, and distressed situations, as well as other thematic topics. Okay, so the other thing I'll mention, because we are short on time, the PowerPoint should be, I believe, uploaded to the GIC website, and then a recent report that I put out on public pensions, trying to peel the onion a little bit, look under the hood, and try to explain to investors and interested parties how to interpret and understand what's going on. Okay, on to the... And you don't need to read all this. I'm not going to go through the whole thing here, but One of my main goals is to be educational and really try to dive under the hood. And you can let the headlines be your friend. I tell investors that all the time. The media and state and local government will report revenues are up, and they are up, and there is recovery going on. But there are also some funny things that happened in the tax code that caused revenues to balloon in 2013, and then in the first quarter of 2014 have fallen back a little bit. I'm not going to go through this extensively, but I do want to mention that a number of headwinds that we do see, and it was mentioned earlier, are the public pension underfunding, which is not across the board. I'm going to talk about that. One of the most important things, if you take away from this discussion, is that the municipal market is nuanced. We have 50 states, 50 sets of rules. We have 90,000 governments in this country of all different stripes, sizes, shapes, and have their own approaches with greater or lesser knowledge about running their affairs. So it's very important to get under the hood and understand what it is that you're investing in. But we do see public pension underfunding crowding out. We are in a time period now where there's very little interest in increasing taxes, particularly to fund legacy costs like this. So I am keeping a folder of examples of some of the crowding out that is taking place in terms of other services that are being provided. The other headwind that's not talked about quite as much is the $1.2 trillion student loan overhang. Young people, millennials, young working people at that time period in the last generation might have been putting that money away to save for a down payment on a house. And right now, many of those young people are saddled with pretty heavy student loan obligations. And that is showing up in the first-time homebuyer numbers, which are pretty significantly down. So to the extent that the real estate market and residential real estate is loosening up, a lot of that is loosening up among later career homeowners who have an asset to sell, as opposed to those that are just going in for the first time. So the first-time homebuyer, I believe the statistic is around 27% or so. Typically, it's been around 40%. So that's down. Not to mention all the politics that we're faced with that are creating very short-term solutions, shorter and shorter time horizons. We're watching the Highway Trust Fund, for example. It's very hard to build a road, put in your cement orders, when you just don't know exactly how your funding is going to play out. Okay, on to some wonky charts, but I'm going to use these charts to tell a little bit of a story. Some of this story is a different slice on other discussions that you're hearing at this conference. This is about volume. I'm just showing borrowing volume in the municipal market. The green bars that you can see are new issue, and total volume is, obviously at the top. The gray bars are refinancing, so that's interest rate sensitive, and that happens when interest rates are low enough to help a government refinance, lower their costs, and take money out. But the one thing that I do want to point out, and I will let the economists in the room and the Federal Reserve presidents analyze this a little bit better, but almost every presentation I see, there was a mystical turning point between 2000 and 2001, and this was in Bob Grady's presentation when investment fell off the cliff, and we see this, and I'll show this in a number of charts. Nevertheless, what I want to point out is that bump that you see between 2001 and 2008, and I'll explain 9 and 10 in a minute, resembles the housing boom. What are municipal bonds used for? Unlike the federal government, municipal bonds are used for infrastructure. What did we do in that time period? We built houses. We built further out into the ex-urban communities, and bonds were used for roads, streets, infrastructure. All of the revenues from the Home Depots, the sales tax revenues were used to secure those bonds, and so on. So that shape very much resembles the housing bubble. And if the 9 and 10 are elevated, the curve would have gone down but for the stimulus program, Build America bonds, which were a taxable bond program that were very successful because the federal government, in its inimitable wisdom, gave a 35% rebate to the municipalities that used it, which was a little distorted relative to the tax code. So it was kind of a no-brainer to issue BAB bonds at that point. I don't want to go into it, but I can later in discussions with people about some of the distortions that created on the curve. But nevertheless, what's happened since then, obviously volume has dropped off significantly. And we believe that it's going to stay low for the reasons that I mentioned in terms of the unwillingness or, no one wants to pay more in taxes for legacy costs, although some states are raising taxes for infrastructure. And also the sort of the supply and demand, the volume is down significantly for those reasons. So the other feature of the of municipal bonds is that they tend to be sold in series. They're not like corporate bonds with typical 10-year structure. They are serial, they amortize, they pay off. But there's also a 10-year call feature. So if you look back at let's see if I can get this laser. If you look back between 2001 and 2, and then you go, that's why my little arrows are pointing over here. If you go to 2012, the jump effectively resembles what happened 10 years prior. And the jump was in refunding, which is this gray bar down here. So we didn't get more new issue finance, but we did get the 10-year call flushing through. So let's see. To show this in a different way, we basically have a supply and demand imbalance. That bubble that you saw, that's continuing to produce cash in investors' pockets. What do I do with it? Where do I reinvest? What am I going to do with it? And that is going to continue to produce cash. I just pulled from the Bloomberg. These are numbers of redemptions and also announced calls on the 10-year and other time periods for some other types of structures. Relative to supply. So we have a supply-demand imbalance that we see going forward. Now, not all of that is going to come back into tax-exempt securities. A lot of it migrates into the equity markets when that's strong and into taxable corporate bonds. This is, again, I'm coming at this from another angle. We watch fund flows, and this is across the different asset classes, and I've highlighted a couple of the events that stimulated money movement on the different funds, and you can see that on your iPads. This is just fixed income only, but it's taxable and tax exempt, high yield and govies, and you can again see some of this is just funds. You can see some of the flows there. This is an unreadable chart that I'm about to put up here, but it is on your iPads. And the reason that it's up here is that we're also monitoring, we watch the global flows, because when municipal bonds become cheap relative to other securities, or not even necessarily cheap, but whether there's an event that's taking place somewhere else in the world, there has been funds flow into the municipal market as well as into treasuries, equities, and so on. So we've been pulling from the Treasury website, we've been pulling the statistics. They're a little bit out of date, so we're only current as of March. But we've been pulling those statistics and separating out, you can separate out which is municipal and which is from corporate bonds. And so the line that I drew here, across here, this is really the only thing that I want to point to on this chart, is that that was the taper tantrum in the summer last year. And so contrary to the funds flow in the US domestic markets, where investors were fleeing some of the funds, there was money coming into the municipal market from foreign investors. Okay, I call this my EKG. You can see, and the main point here is if you look at what happened before the financial crisis, and to John's point about what we hope will happen again in the future is that the municipal treasury ratio should theoretically reflect the tax code. So it should be below 100%. The EKG, the green, is the short-term markets. So that's really all about what was going on in short-term treasuries. We've had, when munis become cheap, we go above 100%. And when they become richer, they go below. And so we've got, a 1-year, a 10-year, and a 30-year to map this out. And so they've started to come back in a bit to where they should be historically. This is, again, just another way of showing this is retail behavior. We watch, behavioral patterns very carefully. This is a large ETF. It's the MUB. And this is the Meredith Whitney sell-off that John talked about here. Those who were smart money that bought at the bottom did fantastic in 2011. The news got out that it was the best performing asset class in 2011 following the sell-off. And the market softened, obviously, because there was a bit of a rush you can see the volume down here. Heavy demand. Puerto Rico also upscaled, upsized a large bond sale at that point in time. And then again, the other point, you can see what happened during this summer last year and kind of how we've returned. But this is just one proxy. Again, we follow. This is just another way of showing the lagging aspect of state and local finance. So what we do is we break out government employment from private sector employment, and you can see pretty clearly what happened in the 07 to 09 on the private sector side. Government was still hiring at that point in time. We've got federal, state, and local. Government was still positive. You can see the return following 2009 in employment. On the private side, government was laying off at that point in time significantly, particularly at the state and local level. Some of the federal numbers are a little bit distorted by the census, so I just want to mention that. And then you can see, again, this is just a one-year time period, year over year, June. Private sector increasing, and we still see layoffs at the federal level. And we do see a return, particularly at the local level, and a lot of that is the school districts that are rehiring and starting to put teachers back in the classroom where they had laid off. Okay, on to public pensions. I'm going to run through this quickly. I just want to frame it up. We have 3,418 public pension systems in the United States. Kind of unbelievable. State of Pennsylvania has over 1,000 public pension systems. The states are, and it's important, the reason I'm bringing this up is that if you are concerned about public pensions, it is important to get under the hood and to really understand exactly what's going on. The state public plans are typically for state employees, for university employees, and so on. And they run agent plans for the locals. And so those are also counted in the state numbers. In the public pension piece that's going to be on the GIC site, what are the most important things? Paying in. That's most important. Governments have not been very disciplined about doing that. Some. Most have. Many have. But the notable ones are Illinois, New Jersey, Puerto Rico. They've taken holidays on paying in. And as you know, if you don't pay in, you don't get the compounding effect. You just lose that completely. You don't get your current year paid. You don't get the compounding of the additional assets that go in. So I've put just, our key things. And Mayor Archer actually touched on the issue of what the assumptions are, assuming a higher interest rate. I'm going to get to that in a minute. This is a Pew Center on the States analysis. What Pew has done, and I just want to, for the wonkier folks in the room that look at public pensions, they've aggregated each state's plan. So you may have a plan. So for example, in the state of Illinois, the state plans are in terrible shape. The local plan is not in bad shape. So that means someone recently said, oh, well, what's going to happen when the local entities can't pay anymore? Well, they're not, the local plan is not as in bad shape, mainly because the state has made the local governments pay into their plan. So it's very important, but here these are all aggregated together. This is kind of a curious little chart. The bars equal 100%, but I just have this here to illustrate, and I don't know if you can read the numbers on the bottom, you can read them on your iPad. It's just a very gross earnings number on total assets. So again, to the point about what was that mysterious thing that happened between 2000 and 2001, if you go back, the 8% wasn't such a bad bogey to figure out going back over time. But that all changed between 2000 and 2001. And if you look at, we had since then for those governments that were still assuming an 8% return, you could be in a lot of trouble. Pension plans were decently funded in the year 2000. A couple of things happened. Monetary policy changed at that point in time. Also, a number of governments, California notably, offered richer benefits to their employees, thinking that this growth period would just continue forever. And so we're living with that legacy at this point in time. But if you started off with $100 at this point, and you moved it forward, and you were assuming an 8% return every year, you'd have maybe about $250 or so in your pocket, rounded numbers. But if you look at these returns, including the years where you had losses and only a 3% return, you'd only have about $180 in your pocket. So the assumptions are off. Okay, let me just go back to this one more. These are, the Census Bureau does show you quarterly returns, and you can see some of the volatility that started. You can see, we didn't go back to 2000 or earlier. We could do that, but this shows you some of the volatility on a quarterly basis that has happened among the largest. This is just 100 of the largest plans. Okay. This is, again, hard to read. I'm just going to point you to a couple of numbers. The Illinois, these are the state retirement systems, but really this is drawn from the financial statements of the plans. And basically what you see, the ugly pattern that you see, is that you have the annual required contribution. There have been some holidays where only 54, 39%, 36% has been actually contributed. And this is on their own numbers. We're not playing with the numbers here, changing any assumptions. If you look at the actuarial value of plan assets, they're eating into their assets. They're not growing them. It's the same here. And then you look at the liabilities, which are growing. So therein lies the problem. Again, back to the point, the local plan, which is not on this chart, is 83% funded. So they're really not as in bad shape. Okay. Just very briefly, perhaps the worst plan out there is the Puerto Rico employees. So there's our big number there. You know, they may be the test case. What happens when they actually run out of money and cannot write checks anymore? Under the hood in Puerto Rico, okay, 2 minutes, got it. Okay, under the hood, Puerto Rico has a member loan program that comprises about 20% of their assets. So a lot of their members have borrowed small loans for homes, for mortgages, for vacations, and what have you. So it does provide cash flow, but that is a fundamentally different asset than an invested asset in bulk. And obviously they have a reserve for some losses on those mortgage loans and so on. So, you know, under the hood in that pension plan, it's not even as strong as, you know, what you see here in terms of the plan assets. Okay, I'm running out of time. I just want to show you some plans that it's not across the board where the problems are. So this is just selected. There are others out there. If you look at Wisconsin, for example, they've always paid 100% or more in. Their value of assets have stayed relatively level. Their liabilities are kind of level, coming down. So they're not in bad shape, not terrifically in great shape, but they're not in bad shape. State of Maine, much smaller, but the same thing, paid in. Value of assets is growing. Value of liabilities is also growing, but not as exponentially as elsewhere. So there's more in the report that... And then this is not for reading, but I do want to mention that in the report, a lot of people are worried about Chapter 9. This is just a resource for you. Do not read it now, please. Half the states do not permit their local governments to file for Chapter 9 bankruptcy, and others have contingent requirements, like the governor has to sign off, you have to go into mediation, so on and so forth. So that is in your package. Here's contact information if you want to see our research. Thank you.
I'll be quick. Hi, I'm Mary Frunker. I have one question for David Kotok. What is that theme song? The last one that we heard, the syncopated clock. Jeopardy, thank you. Sorry. So I'm with Assured Guaranty. It's a financial guarantor, and we basically provide for the full and timely payment of debt instruments. A little history about the financial guarantee industry. It started in the late 70s. In the peak in 2007, there were 7 operating companies. Now there are 2.5. And that was because a lot of the financial guarantors expanded their business and insured obligations, mortgage-backed securities that they didn't really know what they were doing. And so a lot of them are no longer operating. Several of them are in receivership by their state insurance commissions. But just very quickly, and this is a little bit of an infomercial, and I apologize for that, but hopefully you'll come away with some thoughts in terms of, and really my theme here today is turning failures into success, and how we at Assured Guaranty try to do that, and what it might mean for our bondholders. But the important thing to understand here is that we are a well-capitalized company. We are traded on the New York Stock Exchange. I can't speak about some specific things because we are in a quiet period right now, but the most important thing to know is that we have $11 billion in an investment portfolio that covers potential claims and over $12 billion in claims-paying resources on an insured portfolio of about $450 billion. So, basically, as a financial guarantor, we're a credit shop. It's loss mitigation or loss prevention that we really look to. But what do we provide to the buyers of our insurance, both the issuers that are issuing the debt, who are essentially paying for it, and then the buyers of the bonds who actually are more essentially paying for it? What value do we provide? Well, we provide strong underwriting. We have a staff of 30 analysts who basically look at each transaction, review a variety of elements associated with a public finance issuer, and determine whether or not it's an insurable credit. A lot of times what will happen is that we'll qualify a transaction for insurance. It may not be insured, but the investors on the other side of it at least see that we've qualified the transaction. That's what I call the free rider syndrome for bond insurance. But once the transaction is out there, we give it liquidity. You may not know those 80,000 names of potential issuers, governmental agencies. You may not know Mount Pocono School District, but you know Assured Guaranty, and you know that if we're providing that full and timely payment guarantee on it, it provides some liquidity to the debt obligations. The other thing that we do is that things happen over time, consents, waivers, things that require bondholder approval. And as the insurer of the debt, we actually handle a lot of those things. We have a very active staff that I'll talk about. And then the other thing that we do is that when things go wrong, we enforce the rights. I mean, it's very difficult to herd the cats of the thousands of bondholders that are out there. But if you have a single party that's basically representing the rights of bondholders, we do that and we enforce those rights, and we're very actively involved in workouts. I won't go into the detail about our operating platforms. I'm very happy to talk with you further about that. But we do have 3 operating companies that insure different types of debt. And we carry high-quality ratings from the ratings agencies. I'd like to particularly focus on our S&P rating. There's been a lot of volatility in the ratings associated with the bond insurers over the past 5-6 years. What I'd like to point out is that S&P just recently upgraded us. We had been AA minus, and we were recently upgraded to a AA. It did a couple of things for us. It changed the direction. Over the past 5 years, there's been steady downgrades. We have as much in claims-paying resources today as we had 5 years ago, but still we'd been downgraded pretty periodically for a variety of reasons, mostly changing criteria from the ratings agency. It's very hard to hit a moving target, but what happened recently is that S&P upgraded us to a AA flat. It changed the direction, which was huge, and it put it squarely in the AA category, which meant that when you're AA minus, there's a certain level of cliff risk that might send you into the A category, and really having that AA rating has been very important to us. I will point out, I'm a Moody's alum. I disagree vociferously with their rating on us, but the important thing to know is that even if you look at their scorecard analysis of us, they say that we have high AA claims paying resources, and if you're a bondholder, that should be what's important to you. Just a little bit about our portfolio of insured bonds. And I'd like to take 2 quick seconds to talk about the mortgage-backed securities, because that's what got a lot of bond insurers in trouble back in the early 2000s. And Assured Guaranty Municipal, which is formerly FSA, had not insured the collateralized debt obligations. We insured basically the first level of the mortgage-backed securities. And the most important thing is that for us, the model worked on the mortgage-backed securities. We've paid $6 billion in claims on mortgage-backed securities, but we've enforced our rights on those transactions, and we've gotten $4.7 billion back in both cash settlements and reinsurance agreements. And basically, we had a staff of analysts located in Southern California who went through the mortgage-backed security portfolios and said, you weren't supposed to make this loan. This isn't for a primary residence. You weren't supposed to make this loan. This person lied about their income. And so basically, we went and did the forensic analysis, settled with the companies that had issued those bonds, and basically have gotten a lot of the money back that we had originally paid out. Bondholders were made whole on time, in full, and we enforced the rights and got the money back. I like that, sorry. We have a strong portfolio of our insured bonds. Click. A different way of looking at it from both a credit quality and a diversity of sector. And that's across the platforms. The top one is the consolidated. Oops, sorry, going back. So the one thing that I really want to talk to you about, while we have very strong underwriting standards, and I manage a portion of our underwriting business, I bring in the new business. We've got a whole staff of people who handle those transactions for the long haul. We have over 10,000 names in our portfolio, and each of those is touched in some way. We look at some metrics associated with each of those names on an annual basis. We have 30 people who are dedicated to keeping an eye on our portfolio, not just on the new issue side, but on constantly looking at everything. And our average exposure is about $15 million, which is actually the average deal size of a debt issue in the municipal market these days. Sometimes things don't go the way you want them to. And we've had a couple of instances over the past few years of things not going the way that we wanted them to. Stockton, California, we had exposure there, and we've been dealing with that through taking over a building that we had that was financed under a municipal lease structure. The city of Harrisburg had run into some problems. We were actively involved in our work out there and actually insured some of the debt that they issued that was secured by their parking revenues that was part of their workout. I can say how great we are, but actually Kroll, who now rates our Municipal Assurance Corp platform, I think has said it best, which is basically, what you get with a bond insurer is, the financial guarantee, but what you get more than that is a vigorous defense. I mean, when you think about it, an individual bondholder has, a small portion. They have $5 million out of, a $100 million bond issue. But if we're insuring the entire issue, we have a large exposure, we're going to vigorously defend our rights on that transaction. And we have a staff of in-house legal counsel. We engage outside legal counsel, outside restructuring experts to help us through these transactions because of the size of our exposure and the importance, given the fact that we have an entire portfolio of $450 billion in bonds that we insure. The enforcement of rights, not just for the individual transaction that we're looking at any given time, but to basically set precedent going forward. And I think that that's one of the things that's become important in the Detroit case. And I'll talk to you a little bit about that. But the other thing that's most important, if you're a bondholder, is the full and timely payment. Again, we pay in time, in full, on time, and basically collect afterwards. I'd like to tell a quick story about the Jefferson County bankruptcy, and actually I'm going to talk a little bit more about that and how we work through the issue. But there was an instance with Jefferson County, Alabama, while they were going through their bankruptcy, where there was a debt service payment due on their sewer warrants, and the trustee wasn't sure what they should do. And rather than call on the bond insurance policy, just did nothing. We got wind of it. We went around the trustee, went straight to DTC, made the timely payment, and basically bondholders, at least our bondholders, got paid in full and on time for that transaction. We got lots of phone calls from Franklin the next day to basically thank us for acting around the trustee. But basically what happened with Jefferson County was that with their sewer warrants, they had issued a lot of variable rate debt with liquidity facilities. Those were called upon. They were converted into bank bonds. They had a lot of debt that basically came due that was supposed to be long-term debt that was now due within 5 years. They couldn't pay it. They couldn't raise rates sufficient to basically cover that debt. We ultimately worked with them on their workout, and paid bondholders. Bondholders got paid 100 cents on the dollar if they chose the part of the plan where our financial guarantee had come in, and basically we worked with the county to finance their workout with their issuance of debt at the end of last year. A lot of talk has been going on about exposures to places like the Commonwealth of Puerto Rico. And even one thing that I failed to note was that Moody's recently put a negative outlook on Assured Guaranty Corp., one of our operating platforms, as a function of some concerns that they have over our Puerto Rico exposure. And I'd like to just take a couple of minutes to talk about that. We insure over $5 billion of bonds to the Commonwealth of Puerto Rico across a variety of different types of obligations. The thing that's important about us and our exposure, and again, we have $12 billion in claims-paying resources. If you look at, for example, PREPA, the Puerto Rico Electric Power Authority, we insure $850 million of their debt. But the thing to bear in mind is that if they default, we're not writing a check for $852 million. We're writing a check for the debt service as it comes due over time. And so this is amortizing debt, our obligations that come on an annual basis. And so depending upon how things play out with Puerto Rico, our exposure is really a function of what we have to pay in any given time period. That $12 billion portfolio that we have generates over $400 million in revenue on an annual basis. We have an insured book of business that day one of every year generates over $400 million in unearned premium revenue. So I could not breathe for a year and basically still generate $800 million in revenue on an annual basis, which is more than enough to cover what our exposure to Puerto Rico could be. So what does that mean for bondholders? Well, it means that if you have insured bonds, you've been fairly well protected, especially from a market standpoint. This is the evaluated dollar price, the spread between the insured and the uninsureds for the general obligation bonds for Puerto Rico. Right. I'm just going to sort of forward through this, and this is the evaluated bond yields, also as of July 1. And just to put it into a little bit more perspective, the uninsured versus the insured spread as of that July 1 date, the assured value right now is over 10%. So if you're an insured Puerto Rico Power Authority assured bondholder, you're a lucky person right now. Just a little bit more about some exposure. We do insure a lot of the debt associated with the city of Detroit. Our largest exposure is on the water and sewer systems. It's almost $1.8 billion. We've also, again, there been vigorously defending our rights with respect to the Detroit bankruptcy. The one thing I'd like to point out is that some good news. We've reached some agreement with the city of Detroit on what the meaning is of their general obligation on limited tax bonds, and we believe that they've acknowledged the rights, the specific rights associated with that debt, and that's something that we, with the other bond insurers, in that instance, have worked very closely together and very hard on to make sure that we have good outcomes there. And we've put a lot of resources towards that, and I think that that's really the thing that I'd like you to come away with. There's a lot of other information in here. Just very quickly, the insured market right now is about 6% of the total market, but of the insurable market, which we define as the BBB and A rated transactions, we're actually closer to 30 to 40%. With ratings migrations over the past couple of years, where what used to be an A is now a AA, the insured market is a smaller, or the available insured market is a smaller part of the market. But I think right now, outstanding, there's probably about 30% of the municipal market carries some form of bond insurance with it, between our insurance and that of some of the legacy carriers. And with that, I thank you for your attention.
Thank you. Thank you. Thank you. thank you, mystery about municipal bonds, I hope at least has cleared, and we tried to sculpt some fog here. Real quick announcements. Please leave your event pad, and it was a very nice feature to see the chart that Natalie put up that no one could read on the event pad that everyone could read. So we have an adaptation, and all my nervousness, Leanne, about event pads has subsided. Marvelous tool. And some of our entrepreneurs, Hero, are part of it, I think. There's an investment thing, so you can see how it all connects together. This facility has been reserved for July 10th of next year for the Rocky Mountain Summit, in case anybody's having a good time. Lunch will be outside, and because of the time, we are going to promptly resume at 1:30 and start the afternoon program, which will include the Federal Reserve presentation and the global economic outlook. Enjoy your lunch, everyone. Thanks.